my question was fairly simple, which is, look, you raised interest rates by 25 basis points. This is an unusual situation where a lot of average Americans do care about what the Federal Reserve is doing because they're feeling the pain of higher prices at the store, at the gas pump, at the mall. And the Fed chairman effectively told me in response to that the Federal Reserve is going to do whatever it takes to get the prices back down to its 2% target, which it's well above right now, with obviously inflation clocking in at levels that we haven't seen in over 40 years. Now, how the Fed does that is not necessarily about the decision today, because 25 basis points or 0.25% in terms of higher short-term borrowing costs is nowhere near where the Fed needs to be restrictive enough to start to actually dampen down on the demand that's pushing inflation higher. And an interesting kind of answer that he had delivered to an earlier question in the press conference concerned the lag aspect of monetary policy. Keep in mind that when the Fed makes a decision to make borrowing costs higher, that's not going to immediately in the day after, say tomorrow, start to actually pull back on inflation. And the Fed chairman said, look, it's difficult to kind of parse out exactly when the lag effect of monetary policy, a so-called lag effect, is going to kick in. But he said, don't be surprised if we don't start to see the bite, is the word that he used, of higher interest rates actually feed into lower inflation until perhaps 2023 or maybe 2024. The point is that the story that we're hearing about here from the Fed is going to be a multi-year story. And that's why it's less about the interest rate hike that we got today and more so about the interest rate hikes that we're going to see not just in the remainder of this year, with the Fed now telegraphing another 6 possible hikes coming down the pike this year, but the additional rate hikes that we should expect to see in 2023 or 2024. And the Fed chairman said it at the very top of the press conference, look, it's very difficult to project what's going to happen to the economy a year or out from there. That's because of geopolitical issues like, for example, Russia or Ukraine, and especially the virus itself. And that's a big reason why the Fed is going to be in a really tough position as they continue to try to hike rates into the next few years.
And we did see the Fed taking that holistic approach. We heard Jerome Powell saying, look, we're going to be looking at a number of factors from month to month, as well as, really trying to make sure that they're shrinking the balance sheet as well, which he said could also be the equivalent of a rate hike. Do you think that surprised people that on top of the 7 rate hikes, we'll also see this tightening to that level as well, potentially?
Not at all, because everyone was expecting the Federal Reserve to kick off the process of allowing its $9 trillion in asset holdings to roll off at some point. And I understand that all of this is kind of pie in the sky. The point is that the Fed added a bunch of assets during the pandemic to message to markets, look, we have you. Now they're going to try to do the process of actually unwinding some of those assets to kind of also signal to markets, look, we're very serious about dampening down the support that we've given to the markets. The question, though, as you kind of explored with the guests in just a few minutes ago, is the magnitude by which that's going to happen. That could be a surprise to markets, because the Fed, when they were in the process of shrinking its balance sheet after the 2008 financial crisis, basically into the years leading up to COVID, or even before that, really, the U.S.-China trade war, the Fed was doing that at a relatively slow pace compared to the $4.5 trillion balance sheet that they had had at that time. Their asset holdings now are double that. So the expectation is the Fed's going to have to go much quicker in terms of letting U.S. Treasuries and agency mortgage-backed securities mature off of its balance sheet, or perhaps actively be sold back into the market. If the Fed gets more aggressive with that, that's another point of hawkishness that could weigh on markets again. But the Fed chairman suggesting that that is not a conversation for today. Likely could be a conversation, it sounds like to me at least, in the Fed's next meeting in that first week of May. And then we'll see how the Fed goes about actually holding that policy through the remainder of this year.
Yahoo Finance's own Brian Cheung, great to have that insight and context and perspective as well from being on the call with Fed Chair Jerome Powell. Brian, appreciate the time this afternoon.